Hi, everyone, and welcome to my office hours for week 6. Today, we're going to go over the highlights and insights regarding chapter 6, which is about accounting for inventory cost. So here is a list of the items and concepts that you must be aware of to be able to address any questions on exams or quizzes relating to inventory cost. The first thing is there are 3 costing methods, which you need to be able to identify, explain, and decide when to apply the 3 methods. The second point is that you need to be able to perform the necessary calculations about inventory costs, which impact the ending value of the inventory and the cost of goods sold expense, but only for one of the 3 costing methods, that being FIFO. The third thing is to understand the importance of periodic inventory accounts and how we might adjust the accounting records for discrepancies between what the records show and what the physical count shows. The fourth item is how we account for goods that are in transit when we are trying to present an amount for the inventory on the statement of financial position. It's also valuable for you to understand who cares about inventory levels and why. Why are we making all this effort and investing time and expense to track inventory? And then lastly, how we might adjust the accounting records which are tracking our inventory cost in those situations where the inventory value, the market value, is less than our cost. All right, so let's review the 3 inventory costing methods. The first method is the specific identification method. We apply this in situations where the goods themselves are unique. Often they have a serial number, and as you know, for the example provided in the book that relates to automobiles and the business entities that sell them, automobiles have a serial number called a VIN, which stands for Vehicle Identification Number. Now, not everything with a serial number would be accounted for using specific identification. And one of the key attributes that distinguishes the type of goods that would be accounted for with specific identification or not is whether the goods are homogeneous or whether they're unique. So, for example, you might buy appliances from an appliance store like the Brick or Home Depot, and the appliances that you buy have a serial number which you can register for preservation of your warranty rights. But if you're buying a 32-foot KitchenAid double door freezer on the bottom refrigerator, you know, they make thousands of that particular model, and both the manufacturer and the retailer are not going to be tracking these things using specific identification. So in addition to it being unique, such as commissioned artwork or high value gems, one of the other attributes of goods that we'll do specific identification costing for is when they are of high cost and high value, such as an automobile or a commissioned painting or a house, which is, you know, custom built. I think I mentioned in class that builders will consider the houses that they're building to be part of their inventory. The other thing that's important about using specific identification, because the goods themselves are unique, they likely have different costs. Think about the example of custom-built houses. You know, 2 neighbors could be buying the same model from the same builder, but they have flexibility to choose the quality of the finishes, both interior and exterior, and that can result in different costs to the builder. Now, if the builder is interested in maintaining or achieving a certain level of profitability on each house, they might want to know their costs accurately so they can mark it up by a certain percentage to achieve a predictable gross profit margin. So knowing the costs when they vary by specific item is important to be able to price goods for profit. So those are examples of when we'll use the specific identification method. But otherwise, when we're dealing with homogeneous goods, will choose one of the other two methods, and the choice is based on the physical flow of goods. So the first opportunity or alternative is the average cost method. And this method is typically applied when the customer is in control of the physical flow of goods that they choose. So, for example, if you think about clothing on the table in the center of a Costco store, you can choose any particular hoodie or sweatshirt or pair of jeans that you want that's of a certain brand and size, let's say. But there might be 6 of those on the table, and you can have your pick of any one of the 6. So in a situation like that, where the customer is in control of the choice of the particular unit that's moving out of inventory, the average cost system is what the retailer is most likely going to use. The third alternative is FIFO, and this is the one you're responsible for being able to do calculations with. In this situation, it's the merchandiser who's in control of the physical flow of goods to the customer. And one example would be, the dairy cases that you will encounter in a grocery store such as Loblaws. I'm sure you visualized this before, where there's a stock person who's loading in the newest shipment of dairy products in the back of the shelf or the back of a conveyor, and they roll to the front. So when you as a customer open the door, you're picking the oldest item that's available for the particular type of product that you want. So the oldest one available was the one that was first in. It's placed on the back of the shelf first, and then it rolls to the front. When it's placed on the back of the shelf, it's at the back, as other customers that come before you take the goods that were in front of it. The one at the back rolls to the front. So that's a good example of how the FIFO physical flow of goods works, and why it's also the appropriate costing method to use. Now, the grocery store is a good example of where FIFO makes a lot of sense, because controlling the customer's choice of product to choose the oldest one or the first in is going to reduce the merchant's risk of loss of inventory due to spoilage. All right, the second point that we wanted to cover was to be able to calculate the ending inventory value and the cost of goods sold using FIFO. Now, we've done this in class. I introduced an alternative method to what the textbook was using. However, there are high degrees of similarities. In the panels in the textbook, they had a 3-column panel for tracking purchases, where you would identify the quantity that was purchased, identify the unit price, and create an extended value. There's also a panel that deals with the cost of goods sold. But in the FIFO system, this is a little tricky to calculate, and that's why I set up this other panel for the inventory tracking, where we would put the quantities purchased under a column that was specifically identified with a price. And then we would always be able to track in the subtotals at the bottom, or the totals at the bottom, the quantity of goods that was available at each price. And since we are entering the data in chronological order, you can see the dates here running from May 1st with the opening inventory down to May 25th. The highest occurrence of units in this table are the first in. And so those are the ones that we have to sell first. And you can see in this row here, for example, when we're selling 42 units, where inventory on hand was previously 55, that 55 being 30 was the oldest and 25 was the newest, we have to first use up the 30, and then to make up our total of 42, we draw 12 units out of the most recent inventory purchase of 25. So the other thing that I introduced with this method was to allow the valuation of the inventory to be somewhat automatic. We calculated the value of the inventory, or rather the value of the transaction that was occurring, whether it was a purchase or whether it was a sale, by using the sum product function in these cells. The sum product function multiplies every quantity in a row by its corresponding price in the column header and then adds up those products. So I explained that in class. If you have any further questions about that function, you can ask me in a subsequent class or later in these office hours. As well, on this schedule that I've just copied and pasted on this slide, you'll see that there are several checks. I always am checking my work when I'm doing Excel worksheets to be sure that I'm not making mistakes. I don't want to compound an error. So as soon as I enter something, if any of these check digits that you see in here as red zeros, if they switch from a value of 0 to something else, I know immediately I've made a mistake and I can correct it as I'm going. So how these red zero formulas were calculated was explained in class, but I'll give you an example. There's one in the book that asks you to check your work by using the cost of goods available for sale. Well, the cost of goods available for sale is equal to the value of the beginning inventory. In this example, it's $2,850 plus the value of everything you purchased during the period, which was $10,000. So the cost of the goods available for sale was $12,850. And you have to now think about, well, if these were available for sale, what did I do with them? And you could only really do two things. You either sell them or they're still in inventory. So if we take the cost of the goods that were sold plus the value of the ending inventory, the cost of the goods that were sold was $9,235 in this example, which was in class demo question 6.3. And the ending inventory was valued at $3,615. And if you add those two amounts together, you get the same amount, $12,850. So the left side of this equation is equal to the right side. And these check digits simply subtract one of these cells from the other. Pardon me for that inadvertent click. They simply subtract one of these from the other. So I've kind of shown you step by step how the checks work. And the fact that I can quickly see that all of these cells are 0 gives me confidence that I've probably done things accurately. Now, the third item we have to cover is the importance of periodic inventory counts and what adjustments we might make when the count of physical inventory reveals something that is different from what the accounting records show. So the accounting records are tracking our theoretical inventory quantities, and that information is based on documents we received, such as invoices for the goods we purchased from our suppliers, and receiving reports from our own staff who receive the goods and are supposed to count them and confirm the quantity and let the accountants know. And also our sales invoices, and our shipping reports. So the sales invoices is something that we send to customers, telling them what quantity they've ordered and what the price is and what the total value and the taxes are. A shipping report will be prepared by another staff member, which will say what quantity of goods they actually packed and put on a truck. So that documentary information is what we use to supply the accounting records with. And that will allow us to track the inventory quantities in, sorry, I want to go back a slide. In a worksheet such as this. So here we're tracking the quantities. This is quantity in, quantity out, quantity in, quantity out. All right. And then that's how we end up with accounting records that show we have so many goods on hand and what the carrying value is and so on. But periodically, to check on the accuracy of the accounting records, we will conduct a physical count of the quantities on hand for each type of product or product line that we carry. And what we might find is differences might be revealed, and these are caused by discrepancies between the quantities actually received and shipped versus the quantities that were ordered by the customer or ordered by us. And those types of discrepancies can happen, through miscounts or from our suppliers short shipping us or from us short shipping a customer. And eventually, those things need to be first detected or caught and then resolved by, let's say, a supplier short shipped us, we need to contact the supplier and ask them to fulfill the balance of the order. And likewise, we need to inform our customers if we've short shipped them that we will be sending the missing goods as soon as they're in our inventory. The other thing that can happen, of course, is that the phenomenon of shrinkage, which is a euphemism for theft, goods can just disappear, and they can be stolen by customers in a retail store, or they can be stolen by employees who have access to the goods in our business facility. So if there's shrinkage and the quantity of goods available does not match the quantity that the records say is there, then we have to bring the records into alignment with the physical facts, so that when we present a value on the balance sheet for inventory, it represents what's really in existence. So when you consider the fact that inventory is an asset, and we are reporting that asset to the people who read our financial statements, we are representing that we have a certain quantity of goods, they have a certain cost, and the product of the cost and the quantity gives us, the product of the unit cost and the quantity gives us a total cost. So we communicate that on the balance sheet. But we would not be complying with the faithful representation objective if we were placing a value on the balance sheet that included assets that didn't exist. So if there are non-existent assets, we can't report those because there is no future benefit associated with non-existent assets. So the cost amount that pertains to such non-existent assets needs to be removed from the cost that's otherwise represented in the accounting records. And we do that by a process called writing off. It's just a term that accountants use. But what it means is we're going to reduce the inventory quantities in our tracker, and we're going to remove the corresponding cost amounts from the inventory before we present it on the statement of financial position. And as you can imagine, if we are processing a transaction, that transaction must have two parts to it. So reducing the inventory is one part. That effect is going to show up as a reduced carrying value of the inventory on the balance sheet. And the second part is that we are going to charge an expense in the income statement with the same amount. We'll call that inventory loss expense. Okay, so the next thing that you're responsible to understand is how we account for the inventory that we're going to present on the balance sheet when we have to consider the phenomenon that some goods could be moving. These are called goods in transit. And when we are reporting a balance sheet, let's say, this is the month of March. We just finished the month of February. So let's say that we're doing financial statements for February 28th. We could have ordered some goods from our supplier on the 27th or the 26th, and they may not have arrived yet, so they wouldn't be in our physical possession when we go to do the inventory count at the end of February. So if we don't think about considering these goods in transit and we limit our inventory on our statement of financial position to just the goods that are on our premises, we might understate the inventory. Okay, so when we do a physical count, we will count all the goods that are physically on our premises, and then we have to consider whether or not any of our inbound purchases actually belong to us. On the other side of the coin, before the end of the month, we could have our own customers are ordering goods from us, and we could have shipped some of those goods to the customers, so they would not be on our premises. They will also be goods in transit, but they're shipping to our customers. So those are represented by outbound sales. Now the question becomes, what should be included in our inventory of goods considering these three different situations? All right. The general rule is that this depends on the shipping terms, and if the FOB point is the business entity, the business enterprise, then the business enterprise does not have to worry about accounting for goods in transit. What does that mean? That means if we are buying goods from a supplier and their terms of shipment are FOB destination, then the shipping point is us. They're paying the freight. They're taking on the risk of the goods disappearing. They own the goods until they get to our door. So if they're not on our premises, they're not part of our inventory. Likewise, if we are shipping to our customer and our terms of shipment are FOB shipping point, then as soon as we put them on the truck and the truck leaves our dock, those goods belong to the customer, and the customer is taking on the risk of anything happening to them. So when the FOB point is destination from a supplier or shipping point from us to a customer, we don't have to worry about goods in transit. But in any other situation, we do. So if the supplier is shipping goods, FOB shipping point, then we own the goods that are in transit. And even though they're not in our premises, we have to get a document to account for the inclusion of those goods in our inventory. If we are shipping to our customer, FOB destination, then we own the goods until they arrive at the customer. And even though they might not be on our premises, we still own them and we need to include them in our inventory. Okay, so this general rule applies whether you're buying, selling, or returning goods. So the formula for determining the inventory amount to be presented on the statement of financial position is that we include the inventory on the premises always. We include the inbound purchases at cost if and only if, that's what IFF means, if and only if the supplier's terms of shipment were FOB shipping point. And we include the cost of goods for our outbound sales if and only if the shipping terms were FOB destination, okay? So who cares about monitoring these inventory levels? Well, the first stakeholder that cares about this is management. And management has an interest in managing the quantities of goods for each product line. Why? Because, many customers, especially retail customers, consumers, are fickle. They want stuff right away. Think of your own situation when you're ordering goods online. If the website you're visiting doesn't have the goods, you very quickly click and go somewhere else. So if the business entity is out of stock, fickle customers will shop elsewhere. So to avoid lost opportunity sales, management needs to be confident that the goods are on hand or just in time available in order to meet the expected demand for each product or product line. But the flip side of that coin is if we overstock, in order to be sure we've got plenty of goods for anybody to order, that increases the investment of cash tied up in inventory. It also increases the risk of the quantity of goods that can be stolen or go obsolete. So this is what I refer to as kind of needing to apply a Goldilocks approach. You don't want too much, you don't want too little, you want just the right amount. So what is that just the right amount? Well, there's a whole science in operations research to be able to determine economic order quantities. That's beyond the scope of this course, but there is special software, enterprise software that companies can use to determine the appropriate quantity of inventory to carry. And it's, first of all, driven by expected demand, okay? Now, the second stakeholder concern is also management. Management has the obligation to present on its statement of financial position a carrying amount of inventory at a value that can be realized in the future and generate a profit. This is to avoid misleading financial statement users. So this is another reason why they need to have good controls over inventory quantities and also prices. The third one, again, management. Management is responsible for developing a marketing strategy. And if you've taken marketing, you're aware of the 4 P's of marketing strategy. The first one is product. Management has to actually choose which products to sell. And one of the things the inventory control system can do is to help them determine which products are actually moving, which ones are in high demand. And they should be sure they carry more of those and less of the ones that aren't moving, and allow them to actually use other elements of the marketing strategy, such as promotion and price or price discounting, to help move slow-moving products. Management needs to be able to establish control over physical goods in order to minimize shrinkage. And then lastly, we have creditors. Now, inventory is a current asset, and this can be important to creditors in a couple of ways. The carrying value of inventory, first of all, can have an impact on a lender calculating the amount of a loan. And the reason that happens is because they want to be aware of the value of assets that might be available as collateral. And secondly, inventory may be specifically pledged as collateral for a loan. So creditors who have such collateral will want to read the financial statements and be aware of the value of inventory, because it represents a secondary means for creditors to collect the debts that are owed to them if management's not fulfilling that obligation out of operating cash flow. Now, the last thing is what's called the lower of cost or market rule. Now, we don't use this expression in the textbook, but basically what's going on here is we know that inventory is an asset, and we present the carrying value of that asset on the statement of financial position based on faithful representation of its probable future economic benefits. Now, we buy inventory with a certain cost. If that cost is less than the market value, then there's nothing that we need to do to change the accounting for our inventory. Now, this test is going to be applied not on a unit by unit basis, but on a product or product category by product line or product category basis. All right. So if the market value, however, is less than our cost, think about what this means. It means we can't sell these goods for as much as we paid for them. And so if we wait until the future to sell them, we're going to end up selling them at a loss. And in the meantime, we'll be presenting them on the balance sheet at a value that is not realizable, and that will be misleading to the readers of the financial statements. So to avoid that situation, we invoke this thing called the lower of cost or market rule, which means we will present the inventory on our statement of financial position at the lower amount of cost or market. So if cost is the lower, then the inventory value is already the appropriate one. But if market is lower, then we have to write down the carrying value of inventory. In other words, reduce the amount we present on the statement of financial position to its net realizable value or market value. Now, so this means we're going to actually bring down the value we present on the balance sheet for inventory, and we're going to charge an equal amount to our inventory loss expense on the income statement. So that will increase that expense, which will reduce equity. So the reduction in equity balances the reduction in the asset inventory. Now, just for your information, and this is a point that's beyond the scope of this course, sometimes when we determine the amount of the write-down, we will include an allowance for earning a normal gross profit in the future. So, for example, if our cost amount is $12 and our market value is $10, and we normally make a 20% gross profit on our products, then to be able to sell it in the future at $10, we need to write it down to $8, so that in the future, when we sell it, we'll have a $2 profit. Anyway, I don't think you need to be prepared to make those calculations for any assessment in this course. All right, that's it. So at this point, I'll take some questions if anybody has any.
Cool. Hey, Prof.
Victor.
Oh, you're doing well. I think my biggest question that we didn't get to talk about in class was what you were just talking about of reduced cost of inventory, especially inside the Excel spreadsheet. Is there are we able to like go over how we would actually write that down inside of the table that you prepared?
Let me see if I can find it. Now, we didn't actually have that as part of a question.
Yep.
We had an inventory loss as a result of shrinkage, right?
Yep.
But was there not an example in the textbook about this? Let me just see if I can find one, because if it's already prepared, we can simply go over that. Okay, I'm going to share my screen again in a moment, and oh, this is being awkward. All right, so this is chapter 6 in the book. Can you see it?
Yep.
All right. Let's just be sure I'm in the right area here. I'm looking for write downs. They stated they were recording one write down inventory. Okay, so yes, this is an example dealing with Danye Leather. You familiar with this business?
I am not.
So they're a leather goods fashion retailer, which they have stores in some of the major malls. And it seems like they frequently end up writing down the value of their inventory because of the application of this lower of cost or market rule. So these are rather old reports, but what's happened is so they sell leather jackets, men's and women's leather, other leather clothing items and bags and so on. And when they buy these goods, they buy them from all over the world. They buy some from Canada and Italy and so on. And they obviously, when they buy these, they have a cost attached to them, right? So they're using the cost tracking, inventory cost tracking system, such as the one we did in class together. And what that results in is at the end of their at the end of each financial statement reporting period, which could be a month or a quarter or a year, but certainly each year, they end up doing a full inventory count in all their stores all over the world, and their information system tracks not only the cost but also the market value. So the market value is indicated by the prices at which they can sell these goods. Now, let's, for argument's sake, say, and I don't think I can go so far back to 2013 on yahoofinance.com to find this data. But let's, for argument's sake, say that Danye had let's say they had a carrying value in inventory on their balance sheet. It would say for 2013, maybe the inventory was, let's say, $60 million. Okay. So before they make an adjustment, that is the cost amount. And according to the information that we have in the textbook, they recorded a $1.6 million write-down. So in this situation, this would be cost. Then they would have 48.4 million would be the market value of this. Market or net realizable value, however they've determined it. And of course, the difference between these two would be $1.6 million, where the market value is less than cost, right?
Yep.
So this amount of 1.6 million, the question is, how you're asking me, like, how do we account for this? And if you think about how we've made adjustments in our transaction processing Excel worksheets, this $1.6 million has to be accounted for in two parts, right? The first part is we're going to reduce the carrying value of inventory from its cost to this market value of or net realizable value of 48,400,000. So we do that by processing a transaction which has a negative impact on inventory of 1.6 million. That reduces our total assets by 1.6 million. And just like I explained in the presentation summary for an adjustment for shrinkage, we are probably going to charge this to some expense on the income statement. And how we present that, how we caption it, is up to management's choice. So in this course, what we are doing is charging those write-downs to an expense account called inventory loss expense. But probably on Danye's financial statements, they will call it write-down of inventory to market. And it looks like, because they had the same thing happen in 2012, this is one of the risks of being in the fashion retailing business, because the trends are changing and the colors are changing and the cuts are changing. It's very important to be able to buy the right goods and not overstock and so on. Otherwise, you end up with these write-downs. Now, this may be a relatively small expense compared to the gross profit they make on these goods. But it's a repetitive thing. It's a common occurrence in this industry, which is why they had it this would be a 2013 column. They would have a 1.7 million, a similar one in 2012. Okay. And the caption might be here, we call it inventory loss expense, but it might also be called, actually, let me just put this behind it. It might also be called, on some companies, write-down of inventory to market. Also an expense account. We try to keep it separate from cost of goods sold, so that we're not contaminating our gross profit margins. Does that answer your question?
Yeah, my question was more so along the actual because you've built the inventory spreadsheet where we can calculate our inventory, the actual items we get, how much they cost, and using the FIFO method. And what we weren't able to do in class was how to adjust inventory on that spreadsheet.
Right. So let's see if I have a copy of that here. So this was one where we adjusted the account for shrinkage. So we had, if you remember on this one, our inventory tracking record said that we had 55 units on hand. We did a physical count and found there was only 47. So we were missing 8 units. And if you look at the distribution of this inventory here, we only have units that cost us $10, right?
Yep.
So if we are going to make an adjustment to bring the inventory down to the quantity of 47, we're going to have to make a count adjustment, which is a reduction of 8 units here, right?
Yep.
And that 8 units is going to have to, oops, sorry. I should just put -8 in this column. And then it will add up to 8 units this way. Now we have an ending inventory of 47, and the cumulative quality on hand will be 47. And you can see that basically I have an out of balance condition of 80. And the reason for this is that the way this particular worksheet was developed, we don't actually have anything in this spreadsheet to deal with the unusual expense of shrinkage or write-downs to market. Okay. But I now can adjust this at least to show that my ending inventory is only 470. And these amounts will serve the same function as the opening inventory here when we go to start creating the subsequent inventory tracking for the month of July. We did account for the $47 in the transaction processing schedule here. And you can see exactly what I was describing before. We applied the adjustment to reduce the carrying amount of inventory. And when we did that, our ending balance of inventory was 470. So that amount in the transaction processing schedule now agrees with the amount in the inventory tracking, the value that's been tracked. All right. The offsetting transaction amount is accounted for in the inventory loss expense over here. All right.
Yep.
So that, that right now is grouped under operating expenses. Some companies might group that under as a sub account to cost of goods sold, but at least it's in our expenses. So our transaction processing schedule is completely up to date. It's balanced. You see, it's not out of balance, the $80. The only reason this schedule is out of balance, $80, is because we like here, I reconciled this amount here by comparing the quantity on hand to the opening inventory. If I just show you the formula here, it's like the opening inventory plus the purchases quantity minus the cost of goods sold quantity. But because I didn't put this -8 in with the cost of goods sold, or a +8 in the cost of goods sold, like if I put 8 in here, everything would be fine. See?
Yeah.
But it's not cost of goods sold. So I actually need to create a separate column that we could call adjustments. And I don't know that I want to, well, I could do that just to demonstrate.
Yeah.
So we might need to have a separate panel here, which we call adjustments. And then that 8 would go in here. And I'd have to add that to my check formula. So I need actually, this should be not in dollars, but in units. And I would need to add this up. Have 8 units, and then this formula would have to subtract any of the adjustments, or maybe add it. I probably should have this adjustment as being a -8, a reduction in quantity. And then this check would have to add whatever's in the adjustments. Okay. And now it balances. Understand? So you're not going to be required to do this in this course. You're not going to have to update the inventory tracker like in a column like this. All you really need to do is just complete this tracker and then adjust your quantity right at the end. And if we had, for example, if we had ending inventory with quantities in the last two prices, then you probably have to take your adjustment first out of the oldest one.
Mhm.
All right, does that answer your question?
Yeah, definitely.
Okay. Anything else on your mind?
I mean, I would say we go into a lot of like, I mean, as you talked about in class, a lot of us aren't planning on being accountants ever. So what would you say, like going forward, now that we're at like the halfway point, we're done with midterms and so on, going forward, what are the lessons to like really like pay attention to for anyone who's like thinking of going down the path of like business owner, manager, all that stuff?
Well, the first half of the course was basically building a context for you to understand what the financial statements are.
Mhm.
The second half of the course is cherry picking some items from the financial statements and walking you through a path of understanding in detail how those numbers are derived. So if you have any aspirations of being in business for yourself, the more you can learn about these particular items, the more meaningful the financial statements will be when you ultimately go to read them. So next, we spent 2 weeks on inventory. In my opinion, that's too much because there are so many other things that's important for you to learn if you're going to be managing your own business. Next week, you're going to be spending on accounts receivable. That's week 7. That only leaves 3 weeks left. And, there's at least 20 other useful items on the financial statements that you just won't get a chance to cover.
Yeah.
So the point I'm making is that for the items that we're covering in chapters 6 through 10, we're doing a deep dive in helping you to develop some understanding of what's really going on here. Okay.
Mhm.
So for inventory, the main thing was to understand the movement of goods and where the cost comes from on the balance sheet, and where the cost comes from in determining the expense cost of goods sold. This is a particularly important item because the cost of goods sold is subtracted from sales revenue and determines one of the most important profit measures for any business, which is their gross profit.
Yep.
So because almost every analyst, financial analyst, business owner, lender, investor, they focus on this gross profit measure. That gross profit measure is a function of two things: how well you price your product and how much you sell, as well as the accuracy of measuring the cost of the goods that you sold. So in chapters 5 and 6, we spent time helping you to understand how we measure the cost of the goods. Okay. And the reason we have a system for doing it, whether it's specific identification or average cost or FIFO, as long as we are applying those methods consistently from one period to the next, you will get what's described as a robust measure of profit. So what I mean by that is, there could be small errors because we just choose a system which is like a model or a concept, whether it's FIFO or average cost. There could be minor errors in the profitability, but over time, they're like random errors. They just smooth themselves out. Okay. So inventory costing is a decision that businesses have to make, whether they're going to do average cost, FIFO, or specific item. You'll see next week, the main lesson next week when we cover, or I guess you're taking the class this coming Friday. When we talk about accounts receivable, the main lesson for you to take away as a business owner is you sell goods to customers on credit in exchange for a promise for them to pay you. Now, sometimes some customers just don't pay. Either they dispute the value, they have a complaint against the quality, or they don't have the financial means to pay, or they go out of business. And what that means is, if you own your own business, you're selling goods to customers on the day you do it, you're expecting to be paid. But something happens in the next month and you learn from new information, you're not going to get paid. The first thing to recognize is that's a cost of doing business. If you don't sell on credit, you only want to sell on cash, so you don't ever have a bad debt expense, well, you're not going to probably have as much in sales revenue as you otherwise could, because many customers are going to want the credit. They'll go to another supplier. So if the market is competitive by offering credit, you have to do it too. But it's very rare that a business selling on credit collects 100% of the amount customers owe them. You understand?
Yep.
I'm kind of getting into next week. But here's the thing. The main lesson from next week is if I'm your accountant and you own a business, I'm going to give you a balance sheet. And on that balance sheet, there's going to be a number for your accounts receivable. Now, that number can represent one of two amounts. It can represent the amount that you're legally owed by all customers, or it can represent the amount that, in my best judgment, is what you can realistically expect to collect in cash. Which one do you want to know?
Probably the legal one, right?
Well, no.
No.
Because people might owe you $1 million, but if I tell you you're only going to collect 970, the most relevant number to you is 970, because that's the amount you're going to receive. You're not getting $1 million.
I see. So even though I'm like legally owed it, okay, I see.
Now, that doesn't mean that we are removing $30,000 from the specific list of accounts receivable that people owe you. And the 30,000, we don't even know who isn't going to pay the 30,000. We just know that somebody isn't going to pay the 30,000. Or 29 or 31, right? It's an estimate.
Yep.
And that's another lesson, accounting. Most people think accounting is very precise. There is nothing in accounting that's precise except for the amount of cash you have in the bank.
Yeah.
Everything else involves some kind of estimate. The cost of goods sold is an estimate based on a cost flow assumption. The amount of accounts receivable that we can realistically expect to collect is an estimate based on what people legally owe you minus your statistical history of people not paying you. Okay, so back to your initial question. Going forward, if you have any expectations of owning your own business or being a manager in a family business or whatever, the information in this course can help you have a deeper understanding of the concepts that are built into the financial statements. Like what I just told you about accounts receivable, you probably didn't know that. I mean, you've looked at a financial statement, you've seen a number for accounts receivable, but next week we'll explain to you that's not the amount that you're legally owed. You're probably legally owed more than that, but that's the amount that you as an owner can count on getting in cash sometime in the next 15 to 60 days.
Yep.
Okay. So as you go through the remaining chapters, you should be looking at them from the perspective of, okay, imagine I own a business. What does this mean to me? Okay. And from my first point, the example of chapters 5 and 6 in inventory, there are two things about inventory that you as a business owner should be focusing on. Let's start with what I just told you about accounts receivable. The amount that's presented on the balance sheet, you should be most interested to know, can I really collect that amount in cash? Now, you go down the balance sheet in the current assets section, you look at inventory, and there's an amount next to inventory. And what you need to know is, can I really realize that amount of value that I say the inventory cost me? And the example I just showed you with Danye Leather, they had 60 million in inventory. No, they weren't going to realize that. They were only going to realize 48 million, so they had to write it down. So those types of write-downs to the market value make the data on the balance sheet more meaningful to you as a business owner when you're thinking about how can I turn this into cash or profits, okay? The other important thing about the inventory section is knowing how to determine the cost of goods sold affects the very first measure of profit which is gross profit. And whatever that is, trickles all the way down to the bottom. Okay. Anything else?
No, that's it. That was great. I appreciate it. Of
Okay, well, I'm glad to have you back.
course.
All right, we'll see you in class on Friday.
You too. Take care.
Okay, thanks for coming, Victor. Bye.